There's a guy on Reddit who posted his entire financial situation. 43 years old, $78,000 in student loans at 6%, $18,000 on a car at 4%, $12,000 across 3 credit cards averaging 19%. He has $32,000 in his 401k and wants to know if he should pause contributions to pay down the credit cards or keep investing because the market historically returns 10%. 217 comments. Half say, invest, the market beats the interest. Half say, pay the debt, guaranteed return. Everyone's doing math. Nobody's asking why a 43-year-old man with $108,000 in debt and $32,000 in assets thinks the answer is more spreadsheets. Here's what nobody told him. The question itself is the trap. I'm going to explain why the debt versus investing debate is designed to keep you financially paralyzed, and more importantly, how the real cost of debt has nothing to do with interest rates. It's about something financial advisors won't discuss because they can't charge you for fixing it. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan, and I only ask for your email to send the report so I don't store any of your financial data. Link in the description. So here's the thing everyone misses. Debt isn't a financial problem. It's a cognitive tax. Every dollar you owe is renting space in your brain. And you can't think clearly when someone else owns the penthouse suite of your decision-making capacity. This is the central concept nobody talks about because it doesn't fit on a spreadsheet. You know what fits on a spreadsheet? Interest rates, returns, compound growth projections, all the stuff that makes you feel smart while you're actually getting dumber. Look, I spent 20 plus years running a business, surrounded by people who understood how money actually moves, not how it moves in textbooks. And the pattern I saw over and over was this. Smart people with debt made predictably terrible investment decisions, not because they didn't understand investing, because debt rewires how you process risk. It's like trying to play chess while someone's holding a gun to your head. Sure, you know the rules, but you're not going to play your best game. Let me tell you about a story from the 2008 financial crisis. There's this portfolio manager, we'll call him Richard, running about $400 million for a mid-sized fund. Smart guy, Wharton MBA, 20 years experience. He also had a 7-figure margin loan against his personal portfolio because, hey, cheap leverage, right? When the market dropped 30% in September and October of 2008, Richard's fund was down 18%. Not great, but he was actually outperforming the index. His investors should have been relatively pleased, all things considered. But Richard had a problem. His margin call came due. He needed liquidity fast. So he started selling positions in the fund, not because they were bad investments, but because he needed cash. He liquidated holdings that would have recovered beautifully by 2010. His fund ended down 42% for the year, while the strategy he abandoned would have only been down 23%. Richard wasn't dumb. Richard was leveraged. And leverage turns portfolio managers into panicked sellers at exactly the wrong moment. That's not a math problem. That's a brain problem. Now you're probably thinking, okay, but that's extreme. That's margin debt, not a car loan. Wrong. The mechanism is identical, just slower. Any debt you carry creates a background anxiety that influences every financial decision you make. Think of it like this. Your brain is constantly running a risk calculation algorithm. How much volatility can I tolerate? How long can I wait for returns? What's my emergency fund threshold? When you have zero debt, that algorithm runs clean. You can tolerate a 40% drawdown because you know you can wait it out. When you're carrying debt, that same algorithm is corrupted. It's not calculating investment risk anymore. It's calculating survival risk. Can I make the payment if I lose my job? What if rates reset? What if the car needs transmission work? This is what I mean by cognitive tax. You're not just paying interest to the bank. You're paying attention to the bank. And attention is the scarcest resource you have. Here's where it gets really interesting. The financial advice industry has zero incentive to explain this to you. Think about the business model. Financial advisors get paid on assets under management, typically 1%. If you have $50,000 in debt at 7% and $50,000 in investable assets, they want you to invest that $50,000 with them. They'll earn $500 a year. If you pay off the debt first, they earn $0 for however many years it takes you to clear that debt and start accumulating investable assets again. So what do they tell you? They show you the math. Well, if you invest at 10% and your debt costs 7%, you're capturing a 3% spread. That's optimal capital allocation. They're not wrong mathematically. They're wrong psychologically because they're not accounting for the stupidity cost. Let me define stupidity cost. It's the quantifiable damage you do to your financial life by making worse decisions under pressure. When you have debt, you're constantly under pressure, even if you don't consciously feel it. And pressure creates patterns. You chase performance because you need to catch up. You buy high because you feel like you're missing out. You sell low because you need liquidity. You under-diversify because you're trying to hit a home run. Every one of these behaviors has a measurable cost. Studies show that the average investor underperforms the market by about 2 to 3% annually due to behavioral mistakes. Poor timing, emotional selling, concentration risk. Now add debt to that equation and watch what happens. Research from the Federal Reserve Bank of New York found that households with high debt-to-income ratios were 62% more likely to sell stocks during market downturns. 62%. That's not a rounding error. That's a completely different investor showing up to the market depending on whether they owe money or not. So the math argument for investing while carrying debt assumes you're a rational actor who will hold through volatility and avoid behavioral mistakes. But debt prevents you from being that actor. It's a self-defeating strategy. You're using cheap leverage to invest, assuming you'll act like someone who doesn't need leverage. That's not arbitrage. That's self-delusion with a financial calculator. Now here's the part that really bothers me. This whole framework, the entire debate between paying debt versus investing, is built on a false premise. It assumes your goal is to maximize net worth. It's not, or at least it shouldn't be. Your goal should be to maximize decision-making freedom. Those are not the same thing. You can have a high net worth and be completely trapped. In fact, most high net worth individuals I know are trapped. They're trapped by mortgages on houses they can't afford to maintain, trapped by car payments that depreciate faster than they can earn, trapped by lifestyle expectations that require them to keep earning at unsustainable levels. They look rich, they're not free. Meanwhile, the person with a modest net worth and zero obligations can wait for opportunities, can say no to bad deals, can take risks that might pay off in 5 years instead of 5 months. Freedom compounds faster than net worth because freedom allows you to make better decisions, which creates more net worth, which creates more freedom. It's a virtuous cycle. Debt breaks that cycle. It forces you into a vicious one where you're always reacting, never proacting. Let me give you a concrete example with real numbers. 2 guys, both 35 years old, both earning $85,000 a year. Guy A has $30,000 in a 401k and $45,000 in mixed debt. Car loan at 5%, $15,000. Student loans at 6%, $22,000. Credit card at 18%, $8,000. He's contributing 6% to his 401k to get the employer match. After taxes and debt payments, he's got about $2,000 a month to live on, and he's treading water. Guy B has $0 invested and $0 in debt. He lives on 60% of his take-home and saves 40% aggressively. Both guys experience the exact same scenario. In March of 2020, the market drops 34%. Both get furloughed for 3 months. Guy A panics. He's got debt payments due and no emergency fund because he prioritized 401k contributions. He stops contributing to retirement, pulls $8,000 from his 401k with penalties to stay current on payments, sells at the worst possible time. When he gets back to work, it takes him 18 months to stabilize and restart contributions. By then, the market has recovered and he missed the entire rally. Guy B has built a $15,000 emergency fund by living below his means. He has no debt payments. When he gets furloughed, he's stressed but not desperate. He lives on his savings for 3 months, gets his job back, and starts buying stocks in April and May of 2020 at generational lows. By 2023, Guy A has $68,000 in retirement and still $39,000 in debt. Net worth $29,000. Guy B has 0 debt and $147,000 invested, including those 2020 purchases that tripled. Net worth $147,000. Same income, same market. One guy built freedom first and the other tried to optimize while trapped. The difference in outcome after 8 years is $118,000. That's the stupidity cost. To be fair, some debt is legitimately unavoidable. Mortgages, in many cases, make sense. You need housing. Renting versus buying is a legitimate economic calculation. But even then, the question shouldn't be how much house can I afford? It should be how little house can I tolerate, so I preserve decision-making capacity. I know guys who bought $400,000 homes because the bank approved them, when they should have bought $250,000 homes and kept the difference working for them. The bank's incentive is to maximize the loan amount. Your incentive is to minimize the claim anyone has on your future cash flow. Those are opposing interests. And in that negotiation, most people optimize for the bank, not themselves. This gets to a deeper point about systemic design. The entire consumer credit infrastructure is built to keep you confused about this exact question. Think about how credit cards work. You get rewards points for spending, cash back, travel miles. They've gamified debt service. You're literally earning prizes for paying interest. Then they structure the minimum payment to maximize their return and minimize your awareness of how much you're actually paying. If you owe $8,000 at 18% and you pay the minimum, it'll take you 34 years to pay off and cost you $14,000 in interest. But they don't show you that. They show you the minimum payment, $96. That feels manageable, right? Now, multiply that psychology across car loans, student loans, buy now, pay later schemes, and you've got an entire population that's been conditioned to think of debt as normal, as a tool, as something sophisticated people use intelligently. It's not. It's a transfer mechanism. It transfers your future decision-making capacity to someone else's present income statement. Banks don't make money when you're debt-free and investing. They make money when you're leveraged and paying. So every incentive they have is to keep you in that state. The marketing, the rewards, the smart money uses leverage narrative, all designed to keep you renting your own brain. Here's another story that illustrates this perfectly. A guy I used to know ran a small manufacturing business, decent margins, about $2 million in annual revenue. He kept a line of credit open, about $300,000, said it was for working capital flexibility. Made sense. Except he used that flexibility constantly. Not for true emergencies, but for comfort. Sales slow down, draw from the line instead of cutting costs. Want to upgrade equipment? Draw from the line instead of saving. Over 8 years, he drew and repaid that line probably 15 times, always keeping a balance of somewhere between $100,000 and $200,000. He paid about $97,000 in interest over that period. If he'd operated without the line, forced himself to maintain cash reserves and make harder decisions about spending, he would have had $97,000 more dollars and probably made better operational decisions because he wouldn't have had the crutch. Instead, he spent nearly $100,000 on the privilege of avoiding difficult conversations with himself about what his business could really afford. That's the actual product banks are selling, not capital, permission to avoid discipline, and it's expensive. Now, here's the kicker. Once you understand this, the investment question answers itself. You can't be a good investor while you're carrying expensive debt, because good investing requires patience, emotional stability, and the ability to think in decades, not months. Debt destroys all three. It makes you impatient because you need returns now. It makes you emotionally unstable because volatility threatens your ability to make payments. And it makes you think short term because you're always calculating what you owe next week, next month, next quarter. So the sequence is obvious. Kill the debt first, especially anything above 6 or 7%. Credit cards, personal loans, car notes, obliterate them. Not because of the interest rate math, although that's part of it, but because you're buying back your cognitive capacity, you're purchasing the ability to think clearly again. And clear thinking in investing is worth more than any interest rate spread you're trying to capture. Here's what's psychologically difficult about this advice. It's boring. There's no hack, no optimization, no clever arbitrage. It's just discipline. And discipline doesn't go viral on social media. You know what goes viral? 23-year-olds showing their portfolio up 87% in 6 months. Crypto millionaires buying Lamborghinis. Real estate gurus teaching you how to acquire 12 properties with no money down using infinite leverage. That content gets millions of views because it promises the thing everyone wants, a shortcut. but there is no shortcut to building real wealth. There's only the slow, boring accumulation of good decisions made by a person who isn't under financial pressure. That's it. That's the whole game. And the first step to becoming that person is getting rid of anyone who has a claim on your income. I've been retired now for a few years, living off investment income from a portfolio I built over decades. And I can tell you, the most valuable thing I own isn't any particular stock or asset. It's the fact that I don't owe a dollar to anyone. Not the bank, not the government beyond normal taxes, not a vendor, nobody. That means when the market drops 20 or 30%, which it does regularly, I don't care. I'm not selling. I don't need liquidity. I can wait 5 years if I have to. That's the position you want to build toward. And you can't get there if you're making debt payments every month. You'll always be one bad quarter away from making a forced decision. And forced decisions in investing are where wealth goes to die. Let me address the most common objection I hear. But I have low interest debt, like a mortgage at 3%. The stock market averages 10%. I'd be crazy not to invest while carrying that debt. Okay, 2 things. First, that 10% is an average over long periods that includes massive drawdowns. It's not guaranteed. It's not annual. And it assumes you have the stomach to hold through 40 or 50% crashes without selling. Most people don't. Second, that 3% mortgage isn't your real cost. Your real cost is the constraint it puts on your life. The need to stay employed even if the job is killing you. The inability to relocate for a better opportunity because you're anchored to a property. The stress of making a payment that might represent 30 or 40% of your gross income. These costs don't show up on an amortization schedule, but they're real. And they compound negatively in ways you don't notice until you're 55 and realize you spent 30 years building someone else's equity in a banking relationship while your own freedom atrophied. Now, to be completely clear, I'm not saying never invest. I'm saying sequence matters, and the correct sequence is simple. First, build a small emergency fund, maybe 2 months of expenses. Second, eliminate all high-interest debt, anything above 6 or 7%. Third, build a larger emergency fund, 6 months of expenses. Fourth, kill remaining debt aggressively unless it's a mortgage below 4% and you have genuine liquidity cushion. Fifth, then start investing seriously. This sequence gives you the psychological foundation to be a good investor. Without it, you're just gambling with leverage and calling it optimization. The financial industry tells you to do all of these simultaneously because it's more profitable for them. They want you investing while in debt because they get paid on those invested assets. Your debt is someone else's income stream, and they'd like to add their management fee on top of it. That's not advice designed for your benefit. That's advice designed for their revenue model. Here's one more angle that matters: tax efficiency. When you pay off debt, you're earning a guaranteed after-tax return equal to the interest rate. If you pay off a credit card at 19%, you just earned 19% after tax. To match that in the stock market, you'd need to earn about 25% pre-tax, assuming long-term capital gains treatment. Show me the investment strategy that reliably and safely returns 25% annually. You can't, because it doesn't exist outside of fraud. Meanwhile, paying off that credit card is instant, guaranteed, and risk-free. It's the best investment you're not making because you've been convinced by an industry with bad incentives that you need to be in the market now, this minute, or you'll miss out. That's FOMO packaged as financial advice, and FOMO is expensive. I mentioned earlier I built a business over 20-some years. The lessons I learned weren't from business school. They were from accountants and lawyers who saw hundreds of companies succeed and fail. And the pattern was always the same. The companies that survived recessions, industry disruption, and bad luck were the ones with clean balance sheets. The ones that failed were always leveraged. Always. They'd be growing revenue, expanding, looking successful. Then, one bad quarter, one delayed payment from a major customer, one unexpected cost, and suddenly the debt they thought was manageable became fatal. I watched companies with great products, strong teams, and real market demand go under because they'd borrowed to accelerate growth and couldn't weather a temporary setback. That's what debt does. It removes margin for error. And life is basically just a series of situations where you need margin for error. The same principle applies to personal finance. You need margin for error because life is unpredictable. You'll get sick, you'll lose a job, your car will break down, your kid will need braces. The furnace will die in January. These aren't black swan events, they're Tuesday. And if you've optimized your finances so tightly that there's no room for Tuesday, you've built a fragile system. Debt makes every system fragile because it adds a fixed cost that doesn't care about your circumstances. The mortgage payment is the same whether you're employed or unemployed, whether the market is up or down, whether you're healthy or sick. Fixed obligations in a variable outcome world are dangerous, and the more of them you have, the more dangerous your situation becomes. So here's the practical framework. 3 rules. 1, if you have any debt above 8%, every extra dollar you have goes to killing it, not investing. Not saving beyond a minimal emergency fund. Killing the debt, because that debt is a financial cancer, and you're in triage. 2, once high interest debt is gone, build a real emergency fund. 6 months of expenses minimum. This is your shock absorber. This is what allows you to not panic when markets crash or life happens. 3, only after rules 1 and 2 are complete do you start serious investing. And when you do invest, you invest with the enormous psychological advantage of being debt-free. You'll make better decisions, you'll hold through volatility, you'll avoid the behavioral mistakes that cost the average investor 2 to 3% annually. Those 3 percentage points compound to an enormous difference over decades. That's the real arbitrage, not interest rate spreads, behavioral arbitrage. Being calmer and smarter than the leveraged investor sitting next to you who's sweating over whether they can make their payments. Final point on the incentive structure, because this is critical. Every entity that makes money from consumer credit, banks, credit card companies, auto lenders wants you to believe that debt is neutral, that it's just a tool, that smart people use it strategically. This narrative benefits them enormously. Every percentage point of interest you pay is profit to them. So they've spent billions on marketing to normalize debt, to make you feel unsophisticated if you're not using leverage, to convince you that paying cash is leaving money on the table. It's not. Paying cash is keeping money in your pocket, but that message doesn't have a marketing budget behind it because nobody profits from you being debt-free except you. This is what I mean by thinking in systems and incentives. When you see financial advice, ask who benefits from you following it. If a bank is telling you their debt product is smart, consider that they make more money the more you borrow. If a financial advisor is telling you to invest while carrying debt, consider that they earn fees on invested assets, but nothing on debt payoff. Once you see the incentive structure, the advice suddenly looks different. Let me tell you one last story, then I'll wrap this up. My accountant, guy I worked with for 18 years, brilliant with numbers, understood tax code like poetry. He had a client, doctor, orthopedic surgeon earning about $600,000 a year. This doctor had accumulated about $370,000 in debt. Student loans from med school, 2 car notes, big mortgage, some credit cards. He also had about $400,000 invested, diversified portfolio, well managed. He asked my accountant whether he should liquidate investments to pay off debt. My accountant, who earns nothing from this advice either way, told him yes. Sell enough to clear everything except the mortgage, which was at 3.5%. The doctor resisted. He said he was earning more in the market than his blended debt cost. My accountant asked him one question. How much time do you spend every month thinking about your debt? The doctor paused. Said probably an hour or 2, running numbers, checking balances, worrying about interest, planning payments. My accountant said, "You're a surgeon. Your time is worth at least $500 an hour after tax. So you're spending $1,000 a month in cognitive cost, beyond the actual interest. Over a year, that's $12,000 you're paying in mental energy. Plus, you're one malpractice lawsuit or career injury away from having high debt and no income." Pay it off. The doctor did. Liquidated about $280,000 of investments, cleared everything but the mortgage. My accountant saw him a year later. The guy said it was the best financial decision he'd ever made. Not because of the math, because of the peace. He slept better. He made better decisions at work. He started investing again, but from a position of clarity instead of anxiety. Within 4 years, his net worth was higher than if he'd stayed leveraged because he avoided several behavioral mistakes that would have cost him far more than the interest rate spread he gave up. That's what this whole thing comes down to. You're not optimizing for maximum net worth in a spreadsheet. You're optimizing for maximum decision-making quality in real life. And quality decisions come from clarity. Clarity comes from freedom. And freedom comes from owing nothing. It's that simple and that hard. Don't work for money. Own the companies that do. But before you can own anything, you need to stop being owned. That's the sequence. That's the system. Everything else is just noise designed to confuse you into staying in debt longer because your confusion is profitable to someone else. So ignore the noise, pay off the debt, build the foundation. Then invest from a position of strength. It'll take longer than you want. It'll feel boring compared to the leverage strategies you see online. And it'll work better than anything else you could possibly do because you'll be investing with the scarcest commodity in finance, a calm mind that can think long-term without fear. That's the only edge that matters. And nobody can sell it to you. You can only earn it by getting out of debt first.